All right, g'day everyone. If you're in the property development game here in Australia, you know it's just one big decision after another. But you know what? The most critical choice you'll make, the one that can literally make or break your project, happens way before you even think about breaking ground. It's not about the floor plans or the builder, it's all about how you structure the deal. Get it right? You're laughing. Get it wrong? And mate, it gets expensive, and it gets expensive fast.
So, here's the game plan for this explainer. We're going to start with the absolute basics, why this stuff matters so much. Then we'll talk about starting with your end goal in mind, picking the right legal vehicle for the job, and of course navigating that tax maze. We'll even touch on how to wall off your risk and wrap it all up with a handy checklist. So, let's dive in.
Right then, the foundation. So why do we bang on about structure so much? Well, it's simple, really. This is the absolute bedrock of your project's financial health. It's what determines how much profit actually ends up in your pocket, how you shield your personal assets if things go sideways, and how you manage your tax bill. Honestly, think of it like the concrete slab for your entire development. If it's not solid, the whole thing is at risk.
And look, don't just take my word for it. As the folks at Business Depot say, getting the structure right from the outset is crucial. The tax, transfer duty, and legal costs to change the structure after you've acquired the investment can mount up and quickly spiral. And that's the absolute key takeaway here. This isn't one of those, we'll fix it later jobs. Trying to unscramble this egg after you've already bought the land? You're talking about a world of pain. New legal fees, another hit of stamp duty, massive tax bills. It's a domino effect of costs. The golden rule is simple. Get it right from day one.
Okay, so let's get into your project's blueprint. Before you even whisper the words company or trust, you have to stop and answer one massive question. What's the end game here? Are you a develop and sell person looking to flip it for a quick profit? Or are you a develop and retain investor planning to hold on for the long haul? Seriously, this one decision is the blueprint for every single thing that comes next. Because that one choice, sell or hold, sends you down two completely different paths in the eyes of the taxman. If your plan is to sell, the ATO sees your properties as trading stock. It's held on what's called a revenue account, and any profit is just taxed as normal business income, no special treatment. But if you're planning to hold, now we're talking. The property is seen as a long-term investment held on a capital account. And here's the kicker. Your profit is now a capital gain, which means you could be in line for that beautiful 50% capital gains tax discount. Huge difference, right?
Now, a really important warning here. You don't just get to pick capital account because it sounds better. The ATO is going to look at your actual intention based on real evidence, your business plans, your finance agreements, your history as a developer. You can't just say, oh yeah, I'm holding this one long term, then flip it in 6 months and expect to get that CGT discount. It doesn't work like that. Your actions have to match your stated intention, simple as that.
Okay, so once you've got your intention locked in, it's time to pick your ride. We're talking about the legal vehicle that's going to carry this whole project forward. This is where we get into the real nuts and bolts of it all. Companies, trusts, you name it. Let's dig in.
So, the million-dollar question, company or trust? Which one is the right fit for your project? And look, this is the classic dilemma for every developer out there. The honest answer is there is no single right answer. It completely depends on your project, who you're working with, and what you're trying to achieve with your tax and your asset protection.
Let's break down the main players. First up, you could go sole trader. It's easy, it's cheap to set up. But, and this is a massive but, your personal assets are totally on the line. Your house, your car, everything. It's a huge risk. Then you've got the company structure. This is a game changer because it creates a separate legal entity, a protective shield. Your liability is limited and profits are taxed at a flat corporate rate, which is fantastic if you want to reinvest that money back into the business. And finally, the unit trust. This is often the go-to when you've got a few unrelated investors in the mix. Why? Because the profits flow straight through to the unit holders and they just get taxed at their own personal rates. It's clean and efficient for that kind of setup.
Now, stick with me here because this is a super important point if you're thinking about a trust. To get that limited liability protection we were just talking about, you have to use what's called a corporate trustee. All that means is you set up a separate company with one job, to be the trustee of your trust. This simple step puts a legal firewall between the trust liabilities and your personal assets. Honestly, if you're serious about protecting yourself, this is totally non-negotiable.
All right, you've decided your intention, you've picked your legal vehicle, now for the fun part. Navigating the tax maze. Every decision we've talked about so far has a direct knock-on effect when it comes to GST, income tax, and CGT. So let's untangle it. So, if you've gone with a company structure to develop and sell, you're pretty much always going to be what's called a base rate entity. In simple terms, that means your profits get taxed at a flat corporate rate, which right now is 25%. Nice and simple. It's a flat rate, which makes doing your numbers and forecasting your profit way, way easier.
But there's always a but, isn't there? The catch with a company is actually getting that profit out of the company and into your own pocket. You do this with something called franked dividends. Think of it like this. The company pays its tax, and when it pays you a dividend, it gives you a little credit, a franking credit, that proves tax has already been paid. It's clever. It stops you from being taxed twice. The only hassle is that managing all of this can get a bit tricky, which is a big reason why many people prefer the simpler flow-through nature of a trust for distributing profits.
And we can't talk tax without talking about GST, can we? The rules are pretty straightforward for developers. Once your turnover is heading north of $75,000, you have to register. No choice. The good news is you get to claim back the GST on pretty much all your development costs. Think construction, architect fees, the lot. The bad news? You then have to pay GST on the sale price of your new properties. Now, a massive pro tip here. You absolutely have to look into the GST margin scheme. Talk to your accountant about it because it can seriously reduce your final GST bill.
Okay, let's move on to a more advanced strategy now. This is for those of you who are starting to juggle multiple projects or you're taking on a really big one. We're talking about how to build a financial firewall around each individual project to protect the mothership.
The tool for this is called a special purpose vehicle, or an SPV for short. So what is it? It's nothing fancy, really. It's just a brand new, squeaky clean company that you create for one single project. That's its only job in life. It holds all the assets, all the loans, all the contracts for that one development. And its primary function? To quarantine all the risk associated with that project.
So what are the advantages here? Well, number one, and the most important, is risk isolation. If, heaven forbid, one of your projects goes belly up, the disaster is contained within that one SPV. It can't contaminate or drag down your main company or your other successful projects. It also makes the accounting for each job incredibly clean and easy to track. And that, well, that's exactly what you want if you're trying to attract external investors. They love a clean, simple structure. It's just a really smart way to manage both risk and your own growth.
Whew. Okay, we have covered a lot of ground, from the big picture strategy right down to the nitty-gritty tax details. So let's boil it all down into a simple, smart checklist you can use for your next project.
Here we go, your 4-step plan for success. Step 1, define your intention. Before you do anything else, decide, are you selling or holding? Step 2, choose your structure. Pick the company or trust that best lines up with that intention. Step 3, forecast your tax. Get a clear picture of your GST, income tax, and any potential CGT. And step 4, and if you remember nothing else, remember this: get specialist advice. Talk to your property-savvy accountant lawyer before you even think about signing a purchase contract. That small cost up front will save you an absolute fortune later, I guarantee it.
And that's a wrap. So I'll leave you with one final question to think about. Take a good hard look at your business, at your next project. Is the structure you're using truly set up to get you the biggest profit while protecting you from the most risk? If you've got even a sliver of doubt, now is the perfect time to fix it.